Is this you? When you buy a stock, it goes down. I hate to break the bad news to you, but according to statistics, chances are that 74% of the companies you buy are likely to underperform. Before you go off panicking and selling off your companies, do not worry, it's not as bad as it sounds. There is a simple solution to this problem. I have some very interesting research to present today, so stick around to find out more. I always said that diversifying is important. If you went through my past videos, you probably already heard the many times I stress the importance of diversification. Diversification will protect your portfolio from losing money to the point that it puts you out of the game. If you only have one company in your investment portfolio, and if that company fails, you will lose all your investments. If you have 20 companies in your portfolio, if one of those companies fail, you will only lose 5% of your portfolio. But wait, there is more. That's not the end of the story. Did you know that diversifying is not just to protect your downside, it is also to improve your upside. Diversification is also to improve your overall portfolio performance. What do I mean by this? You see, when you pick a stock, any stock, there is a good chance that it will underperform the benchmark. By good chance, I mean to say there is a 74% chance of underperforming. You may be wondering, how did I obtain this number? So precise. How can it be so precise? 74%. Very good question. I will show you some interesting research and findings by Joachim Clemens, John Jennings, Craig J, and Professor Schiller. Before I continue, I'd like to acknowledge them and give full credit to them for their findings. Let's look at the annual returns of the S&P 500 index in 2019. As you can see, in a span of 1 year, market returns are pretty random and follow the normal distribution relatively well. To put things in this context, the year 2019 was one of the better years in the history of S&P 500. It wasn't an extreme year. Here you see the peak to be around 14%. Let's take a look at the next chart. This is the distribution of the S&P 500 for 3 years, from 2017 to 2019. If we look at rolling 3 years return, we can see that the distribution of the market becomes binomial. We don't see a nice single normal distribution anymore. There is a first peak for cumulative 3 years return of about 0% and a second peak for cumulative 3 years return of about 30%. The first peak corresponds to the group of stocks underperforming. The second peak corresponds to the group of stocks that are outperforming. Overall, on the average, the returns are still positive. So just 3 years into investment, you can see that if you hold a portfolio of 500 stocks, some will perform pretty well and some will perform pretty badly. Over time, the stocks will start to show their distinct performance. The good performers will start to separate from the bad ones. Let's continue. It gets more interesting as we go on further. This is the distribution of returns of the S&P 500 for 10 years. From 2010 to 2019. If we expand the time horizon to 10 years, the distribution of returns become trinomial. That is, it starts to have 3 peaks. The first peak corresponds to stocks that perform really badly. Then there is a second peak, which corresponds to stocks that perform quite okay. These are the middle ground performers. Not fantastic, not too bad either. The last pick is the most interesting one. The last pick corresponds to super stocks that outperform everyone else. These are the stocks we all dream to have. Are you still with me? My story isn't finished yet. It gets more interesting. This is the distribution of returns for the S&P 500 over a 20-year period from 1999 to 2019. You can see this distribution is nothing like the first one. Over a short period of time, like 1 year, the stock market has a nice normal distribution with a single peak. But over long periods of time, like 20 years, the distribution of returns is not normal. The distribution of return will be a skewed distribution where the tails are long. Over this period, the average return of the S&P 500 was a cumulative 239%, equating to a 6.29% annualized return. However, the median cumulative return was 52%, which equates to a 2.12% return a year. The median being lower than the average is important. You see, while every stock has a 50-50 chance of being above or below the median, they also have a much higher chance of being below the average. They also have a higher chance of underperforming. To be exact, during the time frame for this 20-year study from 1999 to 2019, 74% of stocks underperform, while only 26% of stocks outperform. And now, you know why I told you in the beginning that there is a 74% chance of your random stock selection underperforming. This means majority of stocks that you choose will underperform whether you like it or not, and only a handful of high-performing stocks will pull the average up. Therefore, buying and owning a few individual stocks will usually lead to poor performance. You need to buy more diverse selection of stocks such that the law of averages work out. What does the skew means for investors? The skew is both bad and good for investors. The bad news is that the skewed distribution of returns stacks the odds against stock pickers. As noted above, for the 20 years ended 2019, 74% of stocks in the S&P 500 underperformed the average. The safest way to avoid an underperforming portfolio is to own funds that include most or all stocks in the index, such as using an index fund or an ETF that tracks the index. The good news is that genuinely skilled stock pickers should be able to greatly outperform the index. Avoiding below average stocks should lead to massive outperformance for an investment manager with the ability to pick high-performing ones. Of course, this is a difficult thing to do, but not impossible. There are some investment managers who are very good at picking the relatively few high-performing stocks. Behaviorally, however, it may be hard to stay invested in high-performing stocks. This is because many of these high-performing stocks have periods of huge drawdowns. If you had owned one of the high flyers in the past decade or two, you would have had incredible overall success, but there will be challenging periods along the way. For example, Facebook experienced a drawdown of 50%, 40%, and two more of 20%. Amazon experienced a drawdown of 90% in the tech bubble, and after recovering had 5 more 25% declines. Netflix has experienced 3 separate drawdowns of over 70%, another over 50%, and 4 more of 25%. Google experienced a drawdown of 65% during the financial crisis and had 2 more of 20% plus. These drawdowns will create psychological stress and undermine your strategy. What to do about the skew? Thanks to the skew, buying and holding a few stocks will likely lead to underperformance as the odds are stacked against you in picking stocks that will outperform the average. The odds are also against you finding an investment manager who can outperform because investment managers also face the same odds of underperforming due to the skew. So, what should an investor do? For most, it makes sense just to own broadly diversified funds such as index funds or ETF. This is so that the law of averages will work out. For some, it may make sense to do both. They may want to have very diversified core holdings as well as own some positions in high conviction stock picks. We must be aware that the odds of underperforming the market is real if we own too few stocks. So you see, diversification not only decreases your risk, but also at the same time increases your chance of getting a multi-bagger. The best part of all is that diversification is absolutely free. Your broker is not going to charge you more for holding many different stocks all over the place. The IRS is not going to tax you more for holding so many stocks. So take advantage of this right away. Agree or disagree with the video? Subscribe, leave a like and comment down below, and I'll see you in the next video.